This is a perfect day to be joined by Warren Buffett in town for a Washington Post board meeting. But let's start by getting Mr. Buffett's reaction to the president's proposal. He is dead set on going after the big banks, and he doesn't want them taking risks. What do you think of this proposal?
Well, I have not heard the proposal. I mean, I was in the directors' meeting all morning. I would say this, that the real key, in my view, you'll always have some banks that are too big to fail, unfortunately. We can't operate in this world without having some very big banks. Regulators hate that fact. I hate that fact. But there will be institutions that, if they are toppling, the government will have to do something about it. The answer, one of the answers, there could be many answers, but one of the answers is to make it so that the CEO of an institution that fails or that goes to the government and needs help really gets destroyed himself financially. I mean, why should he come out any better than somebody gets laid off from a job as an auto worker at General Motors? So I would, if I were running things, if a bank had to go to the government for help, the CEO and his wife would forfeit all their net worth, and that would apply to any CEO that had been there in the previous 2 years. And I think you have to change the incentives. I mean, the incentives a few years ago were to try and report higher quarterly earnings every quarter. That's what Wall Street applauded. That's what the world applauded. And it's nice to have carrots, but you need sticks. And the stick, the idea that some guy that's worth $500 million, leaves and only has $50 million left, that's not much of a stick as far as I'm concerned. So I really think that there ought to be huge downside, because the CEO has to be the chief risk officer of a big bank.
But that's not what is here. What he is proposing is saying that he wants to limit the scope and the size, the scope of the risks that these banks can take, especially if they have depositors' money within them. He doesn't want them making proprietary trades, where that their own books. He feels that that is the way to prevent another type of financial meltdown. Is he right or is he wrong?
I'd have to see the legislation. It's pretty hard to define risk. I mean, at Gen Re, when I inherited it, we had 23,000 derivative contracts. I couldn't understand them, so I got out of the business. But actually, there are going to be big transactions in this world, and lots of commerce worldwide between very large institutions. So exactly how you police that, I'm not sure. The way I would try to do it, in one way, I would try to make sure that the person in charge paid a huge penalty if the place got in trouble.
Okay, well,
and that hasn't happened in the last few years.
Yeah, and also that's, again, not really on the table. It's more of a let's go back to some of the tenets of Glass-Steagall, which separated investment banking from basic depositors' banks. Mm-hmm. And Paul Volcker, the former Fed chair under Ronald Reagan, is front and center here, saying this is what we need to at least get closer to. Do you think we should bring back Glass-Steagall, Warren?
Well, I wasn't unhappy with Glass-Steagall when it was in place. I mean, that is not something that in any way I champion getting rid of. Sometimes it's hard to put the genie back in the bottle. So I would have to see the specifics of it. But the idea of banks taking huge risks where, in effect, the CEO, the bank shareholders suffer. I mean, if you own stock in Citigroup, if you own stock in Bank of America, if you own stock in Freddie and Fannie and all of these institutions, AIG, you don't have to worry about moral hazard. I mean, those people lost 95% of their money, but it's the person that got them into the trouble that's walked away. So I would have a lot of downside for the CEO.
Well, Fannie and Freddie don't get mentioned a lot when it comes to getting crimped on that type of risk and all of the involvement that regulation has bore down on. And I look at that and I say, well, they still have billions and billions of our taxpayer dollars.
Oh, Fannie and Freddie were creatures of Congress. They were supervised by Congress. They actually sent their report annually to Sarbanes and Oxley. And every year, a 100-page report would go over and say these places are operating fine and riskless and all of that sort of thing. Congress was in charge of supervising them. They had a 200-person office that did nothing but look after those two. And look what happened. So I have some doubts about the efficacy of simple regulations. I like to really create personal downside. I think that can be more effective.
Well, in the short term, if this proposal were to get some traction, at least on behalf of the president and some members of Congress, how long before Goldman, which you own, and Morgan Stanley, before they split off and get rid of their bank charters?
I think that would be logical that they would do so. I mean, I don't know anything about the specifics of this, but the banking aspect of it is a very small part of those. I mean, if you're talking about banking, you're talking about J.P. Morgan and B of A and Wells Fargo and those kind of institutions.
But looking at Goldman Sachs and looking now at how everybody's breathing down Goldman's back, you made a $5 billion investment last year at the lows. It looks brilliant now. What are you on paper up about? We were trying to calculate this, but it's hard with the dividends, $3+ billion to the upside now. Aren't you tempted to cash in on some of that? I know you said you'd hold it for 5 years, but sooner rather than later, if the regulatory atmosphere ices out names like Goldman Sachs from taking risks.
I'm not tempted at all. No, that thought doesn't cross my mind.
So you'll hold for 5 years?
Or longer. With the warrants, we have to exercise in 5 years. With the preferred, they can call us at some point at a 10% premium. But no, I would not be bearish on Goldman Sachs at all. Because Goldman Sachs, they fulfill an enormous function in this world. I mean, and the world without investment banks, we'd be moving back a long way into a different century if you didn't have investment banks